Okay, let's get started. My name is Michael Petraka. I am the owner and operator of HAP Financial Group. You came, in my opinion, to the most beneficial seminar that I do. So, for those of you that know me, I consider myself a full holistic financial planner. What that means is when I sit down with someone, I'm trying to guide all of your personal finances through your retirement. And what that more or less means is I can't just sit here and pick some investments and then I'll see you in 6 months and call it a day. The reality is when it comes to personal finance, you can't think about the investments without the tax ramifications. You can't think about the tax ramifications unless you have the proper insurances. What's the estate plan? What's the distribution strategy? So everything factors into everything else. In my opinion, this seminar that I do is probably the most beneficial one in terms of improving your net worth. Whether it's trying to pick some investment that you think this one's going to do better than that one, maybe over time, it might be a scenario where you increase rate of return from 6% to 7% on average. But if there's things you can do where you can move money around in the tax brackets, so instead of getting hit at 22% unnecessarily, we can keep something at 12%. Well, that's a 10% spread. There's nothing I can do investment wise that can guarantee you a 10% rate of return. But sometimes when I sit down with someone new and I go through their finances, I can quickly manipulate their reality to create some tax efficiencies where it's not squeezing an extra percent or two. It might be a 10, 12% difference in what is able to be staying in your pocket. So today we're going to go through a few different items. I'm going to kind of give you a fundamentals when it comes to the tax code, to go over the four pillars of what I think about every time I'm trying to make a decision in terms of a distribution strategy for a client. Three, we're going to go over some of the recent tax law changes. So there were some major ones that just took place about 7, 8 months ago. So we're going to go through kind of what I consider the 10 bigger ones. And then four, we're going to go through a case study of some very normal items that come up that, like I said, little adjustments in how you do things allows you to keep a much higher percentage after tax. And that is the more or less goal that you want to do throughout your retirement. So everyone has the capability of, on the bottom of the Zoom, there's a little raise your hand feature. So if you have a question, feel free to just raise your hand and I can call on you. I do apologize. I am dealing with a little bit of a throat cold, so you might see me grab a cough drop or sip my tea, but I promise you I will get through this. One little disclaimer. Obviously, I am not a CPA. I don't do tax preparation. I'm simply a financial planner that understands probably the most important skill set that I can have as an investment manager is understanding the tax code. So this is a fantastic slide to get us started. So what am I trying to illustrate with this slide? I would love it if the entire tax code was just a simple progressive tax system where if you make 50 grand, you're taxed at 10%, you make 100 grand, you're taxed at 20, you make 150, you're taxed at 30. Really simple. It's not. There is an unbelievable amount of gotchas that are built into the tax code. Today, we're going to go through the majority of them that you need to keep track of as you're thinking about how much income or how much your budget is going to be in retirement. So I always like to start off with the federal tax brackets. Now, most of you are in New Jersey, so obviously New Jersey has their own income tax brackets as well. And I would love, again, for New Jersey to simply match the federal and how they do things. There's a whole bunch of different items that federally gets done one way and New Jersey does it a different way. So a lot of the things you have to kind of look through both lenses. So just to kind of walk through the basics of our federal tax brackets. So if we're doing, let's say, for example, married filing jointly, we have a progressive tax system, which means the more money you make, the higher percentage you're going to take in income taxes. Now, I would love it. It was just very systematic and evenly distributed. It's not. So as you can see, we have a 10, 12, 22, 24% brackets, 32. I couldn't tell you the rhyme or reason. I just deal with what Congress puts forward. So just to walk through a concept real quick. So a big thing that I target for married filing joint is this jump from 22% bracket and 12% bracket. So it's this figure here plus your standard deduction. So your standard deduction for 2026 is a little over 32,000. So right now, it comes out to about 133,000 if you're younger than 65. That means you're still in the 12% bracket. Once you hit that next dollar is subject to a 22% rate. And that actually brings up a very good point. There's your effective tax rate and there's your marginal tax bracket. So let's say, just in that example I just gave, you made $133,001. Your marginal tax bracket, your very last dollar you earned, would be subject to the 22%. So your marginal bracket, 22. But your effective tax rate might be, 10%, because this is a blended tax rate. So the first 24,000 tax at the 10%, from 24 to that 100,000 figure here, tax at 12%. So it's not a situation where everything would tax at 22. It's a blended rate of all the different brackets. Now, as I mentioned, it wasn't evenly distributed in terms of the rate you pay. There's two big jumps that takes place in the tax code for whatever reason. 12 to 22, which is almost a double. Hence why I spend a lot of time with people trying to manipulate and get ourselves under that leap to the 22% bracket, as well as the 24 to 32. That is a pretty seismic leap. But for a whole chunk in the middle, as I go back a slide, really from 100,000 to about 400,000, you're kind of in the same spot, 22 or 24%. I would argue I really wouldn't care. It's not really that much of a big deal in my eyes, considering all the other stuff you have to think about when you're in the 22 or 24% bracket. But again, if you're close to these big leaps, you want to be very conscientious of that. Now, those are your tax brackets. And then there's tax rates for capital gains. This is, you can sell a piece of real estate that's not your primary residence, as well as some stock sales or bond sales or commodities. So you can have a situation where, let's say someone's in retirement and their overall income is less than this 98,900. If you sell a stock for a gain, your tax rate's zero. I don't think people realize this sometimes. If you're in a low enough bracket, you can sell some stock and pay nothing in taxes on it. So you want to be conscientious of where you are in terms of income, again, for tax bracket purposes, as well as capital gains rate in terms of what you have to pay when you liquidate positions inside of a taxable account. For most of the people on this call, this is not something you're going to have much control over. What this is the taxability of Social Security. Now, the problem with this reality is they haven't indexes for inflation. So it's almost impossible, really, especially in New Jersey, to be under these thresholds. So more or less, when you're taking income from Social Security, the question is, will that income be taxable to you or not? Long story short, if your income's above 44,000, so how do you calculate that? It's half of your Social Security plus all other types of income that you have coming to you, except for income from, let's say, a Roth IRA. If that figure comes out to more than 44,000, long story short, up to 85% of your Social Security is going to be taxable. For almost everyone on this call, your Social Security is just going to be taxable. It's just going to be the reality. And just to be clear, it's not that the tax is 85%. If you were to get $10,000 from Social Security, 85% of that, which is $8,500, would just be added on to your taxable income. And so, like, if you're in a 20% tax bracket roughly, you're going to owe around $2,000 in taxes on that income. So we have some realities of, all right, we're looking at the tax brackets, we're thinking about Social Security taxation, and then we have the Medicare premiums. So for individuals 65 and older, everyone is on Medicare. So Medicare Part B is the one you have to pay for, as well as Part D. And these are realities based on the level of income you have. It'll adjust, your premiums will adjust. So these are scenarios. Let's say if you're married filing joint and you happen to sell a big stock and did it all in 1 year, and it ballooned up your income till you made $218,002. Because you made an extra $2, you jumped your premiums for the next year from $202 to $284. For a married couple, that impacts both of you. That's almost an extra $2,000 a year of after-tax money that just evaporated because we weren't conscientious of where the Medicare premiums are. So you definitely want to have an understanding of where they are, because again, these figures can go pretty high. So the lowest is $202 all the way up to almost $700 a month per person. So again, definitely one of the items you factor into your retirement budget planning. So for those of you that live in New Jersey, there's a few different programs that New Jersey provides to help ease the burden of retiring in New Jersey. There's the Anchor, the Stay New Jersey, and the Senior Freeze. I believe it's all in one application now, which is rather nice. These are the realities that we want to make sure we're under. So the first one, or the lowest income threshold, is that Senior Freeze. This is a situation where if your property taxes are 10 grand, we want to stay at that 10 grand. So as they adjust every year a little bit higher, if you stay under the freeze amount, then you've locked in that rate. And that's for income less than 172. The other two programs for homeowners, if you stay under 250 and for 500, you get additional benefits from the state of New Jersey. So this is one, again, I can happily email you the slides just to grasp the concepts of what incomes you have to be under, as well as the benefits that you'll be entitled to. So what you would hate to have happen is if you locked your property taxes in for 10 years, and then again, you sold some stock and it ballooned you above the threshold, that's a reality that could have an impact on your freeze. So last year was a very eventful year when it comes to the tax law changes. So I just want to highlight some of the things that took place. One is all the tax law changes that happened in Trump's first administration. The personal ones were actually temporary and were going to sunset and go away. In the laws that he passed just last year, he made them permanent. So those tax brackets, the 10, 12, 22, 24, are here for good. And when I say for good, it just means until they change the tax laws again. Standard deductions are going to be indexed for inflation. So like I said, for 2026, the new standard deduction will be $32,200. There's going to be a temporary increase in the SALT cap. This is a big deal for people in Jersey, New York, Pennsylvania, Connecticut, California. So it used to be a situation where almost everyone in New Jersey used to itemize, but then they capped your SALT, which is your state and local tax deductions, at 10 grand. So that was kind of brutal because most people's property taxes are already over 10 grand. So you weren't able to deduct any of your state income taxes. Very kind of frustrating. But now a lot more people are going to be able to itemize because they changed from 10 to 40. But again, that's actually only for the next few years, and that goes away. We'll see where that shakes out in a few years. Now, another big perk is for people 65 and older. They're going to get an additional $6,000 or $12,000 per couple, as long as your income is below 150 grand. So this is a reality where if you just think about your standard deduction, which would be $32,200, plus this new one, which is additional $12,000, plus the normal benefit you get for 65 and older, which has come out to $1,650 a month, you're quickly, just to add those up, 244, you're at 47,000 and change of a standard deduction. Not a bad reality. Now that additional 12,000, that's going to go away in the next few years. Again, that will also sunset. Some additional perks. There's no tax on overtime or certain qualified tips. But there are some details worthwhile. So if that's of interest to you, we can have a sidebar conversation. Car loans, if you have a U.S. assembled car, up to $10,000 is of the interest is deductible. Nice little perk. One of the bigger ones that kind of sad to see go is the clean energy credits that's being phased out. So if you were doing solar panels or electric vehicles, You pretty much had up until the end of 2025 to complete that. Some big changes that took place in 401ks. So if you're older than 50 and you were used to maxing out your 401k with catch-up contributions, now those catch-up contributions, which come out to 8 grand, have to be done in the Roth, and you cannot do pre-tax. Now, there's also a special one between 60 and 63 years old that instead of 8 grand, you can do 11,250. I'm not 100% sure why they created that special little category, but they did. But again, those have to be done inside the Roth. Charitable deductions. For those of you to get a charitable deduction, you used to have to itemize your tax return. Now you can do a standard deduction and get up to $2,000 per couple with charitable contributions. And if you do itemize, there's actually a 0.5% floor on your AGI. So for example, if you make 100 grand, the first $500 that you would give to charity won't count as a tax deduction. So in recapping, as we're planning for distributions in retirement and kind of budget planning, where are we in terms of tax brackets, Social Security, the New Jersey programs, and Medicare premiums? These are the things you want to think about. So right off the bat, what I always recommend, if Uncle Sam is trying to give you a tax break in some which way or form, take advantage of it. Like I said, it's very hard to get more and more rates of returns from investments, kind of like, squeezing blood out of a stone. But if Uncle Sam's going to give you a 20% break here, a 15% break there, you say thank you and you utilize it every time. So I either want a tax break or I want something tax free. I want to fill up those buckets every time. So if you have money in a taxable account, such as a joint account or a brokerage, you should have gone through every single year. Could I put it somewhere to get some sort of tax advantage, such as a health savings account, a flex spending account, Roth, which is I'm not going to get a tax break today, but it's growing tax free for all of time, or traditional pre-tax contributions where you're getting that tax break today. Again, you just want to fill up any tax advantage vehicle possible. So now we're going to meet really a scenario that I probably come across once a week when I meet someone new. Meet Sam and Mary here. Very typical situation. Both of them 60 years old, want to retire in a few years, and then eventually want to take on Social Security at 66. So they're going to retire at 63, so they're not quite at Medicare. There's going to be a few year period before they touch Social Security. Let's say if they can pull it off. So what's their scenario? Well, all in, they have about $2 million. Good job. Most of it is pre-tax inside of their IRAs. And then they do have smaller balances inside of Roth and a little bit of money in a joint account. So they want to spend about $12,500 a month. It's 150 grand based on their assets and Social Security. That's doable. So what do we want to look to take advantage of? So what do we know? They're retiring at 60. They probably didn't turn on any pensions yet. They're 60 years old now. They're retiring at 63, and they're going to turn on Social Security at 66. So what does their tax bracket look like over time? So right now they're in the 24% bracket. Eventually, their RMD years, RMDs are, some people's RMD age was 72, some people 73, some people at 75. So let's say in this hypothetical, your RMD was 73 years old. From RMD age on, they're going to be in the 22% bracket, but we have this window of time between 63 and 73 that they might find themselves in the 0% bracket all the way up to 22. So if we have years where we're going to have low brackets, these are times where we might be taking distributions from IRAs early to only pay maybe 0 or 12%, or process Roth conversions in this time frame. We never want to miss an opportunity. In essence, what you're trying to do is levelize your income throughout your retirement. So it's, you always want to fill up that 12% bracket if you have an opportunity. So these are typical things that come up during the meetings that I have. Well, let's say Sam likes to trade stocks, but he doesn't factor in taxes. So one of the things I always cringe at is typically when someone has a stock account, it's in a brokerage account or in a joint account. It's kind of the worst place to be an active stock picker, because what happens when you're buying and you're selling, you're paying your tax bracket rates instead of long-term capital gains rate. So this is a situation where if you let's say, bought something and you made a quick double and you were so excited and you sold it. Well, you might be paying 24 or 32% rate as opposed to long-term capital gains rates at 15. So you want to be a little bit more passive in your taxable account. I'm not opposed to someone having some fun and buying some stocks that they like. You might want to do that in the IRA or in a Roth. Ideally in a Roth, if you're particularly good at stock investing, in which case you think you're going to have great rates of returns, you want that more inside of the Roth. While working, we invested in muni bonds but didn't revisit after retirement. Long story short, unless you're in the 32% bracket, in my opinion, I wouldn't be too top heavy in munis compared to corporate bonds or treasury bonds. That doesn't mean you don't have a sleeve. In most of my models, I have a sleeve in munis. They act a little bit different than the rest of the bond, but you shouldn't be muni as your primary core aspect of your bonds unless you're in the 32% bracket, in my opinion. This next one's a big one. To keep things simple, we kept the accounts invested the same way. It's not really ideal. So let's have a basic example. Let's say you are right down the middle in terms of a risk tolerance. You like nice balance 50-50. 50% stocks, 50% bonds. Well, if you have 100 grand in an IRA and 100 grand in a Roth, Roth's growing tax-free for all of time. Your IRA, you have a partner that's going to take a cut every dollar you earn or every dollar that you eventually take out. So in essence, you want the Roth aggressive, the IRA conservative. The combination of the two should be 50-50 in terms of risks, stocks to bonds. But you definitely want to be top heavy in stocks, maybe an 80-20 inside of the Roth and a 20-80 inside of your IRA. Again, to have the blended risk that you're comfortable with. But, we want the return where we don't have a partner taking a cut of everything we earn. I sold the stock at a big loss, figuring I would carry the loss until I had gains in future years. You may remember at the beginning of this conversation, I said New Jersey doesn't have the same rules as the feds, and this one is painful. So let's say you have a position that you bought for 100 grand and you eventually sold it for a $50,000 loss. If you sell it all in 1 year, the feds will say, all right, I feel your pain. You can take the loss and wipe it away versus other gains you have from other sales. And anything you're not able to wipe with other stocks you sold for a gain, you can carry it forward with you, and you can take $3,000 against your income every single year. New Jersey goes, I'll let you wipe it against other things you sold for a gain, but you carry forward nothing. So you really don't want to have too much of a carry forward loss if you're in a high New Jersey bracket reality. You really just want to sell enough to get to cover all your gains plus maybe $3,000 that you could take against your income. Other than that, I would rather leave the losses on the books and sell it a little bit at a time over the next few years just because of the New Jersey reality. I love this particular stock. It's going to come back. So let's say we have a position. I'm just going to utilize Home Depot and Lowe's just because they're the same type of company. So if you had Home Depot, and now is at a loss, what you want to do is you want to sell it to harvest the loss that you could take a deduction for. But you might say, well, what happens if Home Depot rebounds in that particular time? Well, that's when you would buy Lowe's. They're going to track each other pretty good, at least in the short term. So there's what's called a wash sale rule, meaning if you have a position at a loss, you can't buy it back in 30 days or you can't take the deduction, but you could buy something very similar. So this is a situation where, again, you would sell Home Depot at the loss, buy Lowe's in 30 days, you can go back and buy Home Depot if you would like. These are great. You could also buy a sector ETF that tracks it. So for example, if you have one of the big tech names and you took a loss, you could buy a sector ETF that tracks the whole tech world and then again, wait the 30 days and buy it back. We can't avoid the pain points. You can just take advantage of them. When markets are down, take advantage. When stocks are down, when your income's down, it might be because of a horrible reason, but there's just a different tool set that you use in those realities. Don't miss those opportunities. Excuse me. We were so upset that our accounts went down, we didn't open the statements. Again, we don't want to miss opportunities. If your investments are down, let's say you have 100 grand in an IRA and we got killed and now it's 60 grand, we had a $40,000 loss. That's when you want to process a Roth conversion. So think about it, your 100 grand, if you convert it up here, you're paying taxes on 100 grand of income. But if you convert it down here at 60 grand, that's a much lower amount that we're going to have to pay because it's a smaller dollar amount. So we can convert at the bottom, and now our rebound is going to be tax-free inside of a Roth. So if we're in a bad recession or you're in between jobs, take advantage of it. We were over the income limit, so we didn't think we can contribute to a retirement account. So these are two sneaky ways that I don't even understand why they exist, but they do, to get money in a tax-advantaged vehicle while still being over the certain income threshold. Backdoor Roth contributions. So these are for individuals that can't deduct an IRA contribution and make too much money to contribute to a Roth IRA. What you can do is contribute to a non-deductible IRA and then immediately convert it. There's no income limits on conversions. And when you do that, since you just contributed the other day and you didn't take a deduction for it, it's all basis. So it's a tax-free conversion. So for a lot of clients, I do backdoor Roth every single year for them. And you got to realize, so like, why are we doing this? All right, let's say we could put 8,000 away. Well, if that's in a taxable account, between federal and state, they're going to take 20% of your cut on average, every dollar you earn. So we magically just went into a bucket that's tax-free for all of time, as opposed to having a partner taking 20% of our cut indefinitely. You put that 8,000 away consistently every single year. These things compound, they get bigger, they can be passed on. Inheritance planning, you don't pass up these opportunities. Another one that is not too common, some 401ks, once you've maxed out your contributions, let's say 24,500, allow you to continue to contribute in an after-tax fashion. And then when you eventually retire, you can move the after-tax money and put it right into a Roth IRA. I'm not sure why that exists, but it does. Maybe about 5% of plans allow for it. Some of the bigger ones do. Can't hurt to ask. But again, not material unless you've already maxed out. Charitable contributions are a big one. A lot of people just cut a check to charity. Most of the time, again, wonderful. I don't want to get Yes. Please give as much as you feel comfortable with giving to charity. But if we can get a 2-for-1, a tax deduction on top of the positive thing you're doing, giving it to charity, yes, let's take advantage of it. Bunch of different ways to do so. One, a lot of people were using the standard deduction. So if they gave $5,000 to charity, you weren't getting a tax break for it because you were already just using a standard deduction. So sometimes, let's say you wanted to give $10,000 a year for 2 years. Well, if you bundle those up and do 20,000 in 1 year and 0 in the other, it could be a situation where 1 year you itemize and then the next year you use a standard deduction. A second way of doing it, this is one I personally do, is I have stocks that I've done well on and they've grown. A lot of the bigger charities, you can donate the stock without selling it. So if I have a position that I bought for $10 and now it's in my account, it's worth $50, I gift them the shares, they sell it, they pay no taxes, they're a charity. I avoided the 20% haircut from the feds in New Jersey. So I get a charitable break and I avoid the capital gains tax on selling the position because I gifted to them in kind. A donor advised fund, these are great. If you think you're going to have one big year, maybe you sold a business and you want to put like 10 years worth of charitable contributions and you want that tax break in the 1 year where you're going to be in the highest bracket. So let's say you sold a business for $1 million, you could put 100 grand into a donor advised fund, get the full deduction in that year. Now this is an account that you control. And over your lifetime, you could dish it out whenever you want. And another great one, the one we primarily use mostly, is what's called your QCD, Qualified Charitable Deduction. That's directly from your RMD. So if you're at the RMD age, either 73 or some people 75, you have to take some money out of your IRAs and 401ks. If you cut the check directly to the charity, for federal purposes, New Jersey doesn't care, sadly. You can use the pre-tax money to give to charity and it'll lower your tax bill. These are big. I'll probably say 4 or 5 clients go through this every single year. Situations where someone has humongous medical bills, maybe they're in a nursing home, they're spending 12, 13,000 a month. A lot of times people just use what's easy to access, most time bank accounts. These are huge tax deductions. You want to use all of their pre-tax money, because your pre-tax money is going to come out and pay taxable, but you have these huge deductions wiping away that tax liability. Don't touch your bank accounts, liquid money, Ross. You want to use all the pre-tax money because you got these huge tax deductions. Again, the goal is pre-tax, avoid your cash, Roth, sometimes annuities, but that's kind of situational. This one's a little bit more fear than reality. A lot of people think the government's coming for your estate. Federally, the limit's $30 million. If you have more than $30 million, you better be calling me, and I need to know about it. But no, for federal purposes, unless your estate's under $30 million, you have no estate tax. New Jersey no longer has an estate tax. They do have an inheritance tax. So if you give stuff to your kids, nothing, no inheritance tax. If you go a little bit further, a brother or sister, they're going to pay, I believe, around 12, 13%. And you go even further, cousins and friends, they might pay 17% of whatever you're going to give to them. So again, no estate tax, but inheritance tax depending on who you leave it to. So this one's a little nuanced. Like I was saying, if you're leaving stuff to friends and cousins and people of that nature, you might want to do pre-death planning. But especially if you're leaving things to your kids, you want them to get a step up at death. If you have a house that you bought for 100 grand that's now worth $1 million, if you gift it to them while you're alive, you're also gifting your cost basis of 100 grand. So when they go to sell it, they have to pay taxes from the 100 grand. If they inherit it at death, then they'll get a step up and they'll only pay taxes based on whatever it was on the date of death and when they go to sell it. Lastly, for those of you, everyone who's a client who's on this call knows what this is. This is your cash flow over time. This is the most important document you have. I recommend everyone has it. But in essence, what you're doing is taking all the tax planning and investment planning and distribution strategies and tying it together, and you're trying to see if the numbers work. We can't have red in this column here. We've run out of money at 85. So this is where you take all the planning and you see if the numbers work. So I highly recommend everyone has a cash flow. If you're a client of mine, you have it. This is a new slide I started to add. This is something that is just, we'll call it wisdom, has been acquired by me over the years in terms of where do people really get financially hurt. It's not from 55 to 56. It's not in random years. It's during transitions. You need to plan around the transitions. So that's kind of a big focus of our firm. One of the ones that really get hurt is widow planning. Everyone's like, oh, they're my beneficiary. That's not widow planning. There's a lot of little details that need to play out fairly quickly after someone passes. And while your widow is in a highly emotional state, having to make these decisions and hear these concepts for the first times, you're kind of asking for trouble. But again, always have a game plan around these 4. My throat's telling me I'm at the end of the presentation. Obviously, I went over a whole bunch of concepts tonight. If any of them pique your interest and you want to have a follow-up conversation, I'm happy to do it anytime. Shoot me an email, give me a call. Obviously, I kind of like this stuff. So, this is the Rubik's Cube of finding the sweet spot of creating efficiency in your own little world. But again, thank you so much for joining me tonight. If you have any questions, feel free to reach out.